I am going to bring up Chuck Crow. Chuck has been a key numbers class instructor, 24-hour educational trade room educator, and trader with special focus on the night owl trading sessions held at 9 p.m. Central Time. Chuck Crow is one of the original employees of DTI and learned side by side with Tom Busby since he embarked on a career in trading education. Working as a clerk for Tom in early 1996, Chuck completed his education in just 3 years, later receiving a BA from Spring Hill College in 1999. Chuck is an expert on watching key numbers and has written DTI's pre-market planner since 2001. Chuck currently hosts the Night Owl, where he instructs students on what to look for during night market and upcoming day market, as well as providing an overview of market weeks, months, and quarters. So give me 1 second, guys, to welcome Chuck to the room, and I'm going to go ahead and promote him here. And Todd, you definitely can go back to the internet as well. Chuck, there you are. And Chuck, are you here with us?
All right, let's see.
Perfect. I can hear you, Chuck, loud and clear. Go ahead and take it away.
Okay, looks like everything's working the way it's supposed to. And are you guys able, James, am I showing my image?
Yes, I see DTI Trading Institute and Trading at the Speed of You on your screen with a nice blue background.
Great, great. So let's go ahead and get started here. We're going to be talking about fear and greed today, but first I want to give you a little introduction to DTI, and of course we have to start off as always with this risk disclaimer. It's always part of the business. You've seen it more than once today. Basic points: trading is risky. You can lose money. Don't trade money you can't afford to risk, and past performance not necessarily indicative of future results. I think that gets the basic points across. All right, so who is DTI? Trusted name in trading education. We got an A+ rating for the Better Business Bureau. Look us up, find out. We're here, DTI headquarters, Mobile, Alabama. Nice big building out there. Founded in 1996. You can see the address, phone number 800-745-7444. So all that information is there. And by the way, if you have any questions at all throughout the presentation, please feel free to type them in. I like interactive presentations. That's the way I go. So feel free to type in at any time. All right, so fear and greed. First of all, fear. And this is, the biggest thing. And I got a question for the room. What are you afraid of in trading? Because most often what you find out is the fear of trading is likely something different than what you think it is. And there are ways to combat fear in trading, but you have to know what it is you're afraid of. So first of all, most people fear losing money. And this is actually the wrong thing to fear. Because, well, if your fear is losing money, then you need to rethink about being in this business. You need to basically just maybe look a different direction or get that under control before you start trading. Rule number 1. There is a reason people say all types of trading involve risk. The reason is trading involves risk. You will lose occasionally when you trade. And if you can't deal with that, that's going to be a tough road. It's going to be a tough thing to get over. So you need to accept that concept. There is risk in trading. And of course, the big thing here is only trade with money you can afford to lose. Well, that sounds all nice and neat, but how many of you have discretionary income sitting aside that you can afford to lose? Now, most people don't work that way. Most people are living on some sort of a budget, most people out there who want to get involved in trading, they want to get involved in trading because they want to have discretionary income, not always because they already have discretionary income. So how do we fix the money fear? Well, the main thing that I would say is you should have some sort of a monthly budget for running your household, right? Typical items in a household budget. You've got mortgage or rent payments, power, gas, car notes, groceries, phone bill, debt payments, credit cards, whatever it is. You've got all these little things that you budget for on an individual month. Well, add in an item like trading. And the thing about this, it sounds like, okay, we want to be able to open up a $5,000 trading account, so you're thinking, okay, well, I'm not going to put $5,000 a month on my monthly budget. That's ridiculous. I agree with that statement, but consider rent. How much do most people pay for rent or mortgage? Let's just, for argument's sake, say you're paying around $500 a month. Now, if you're living in New York City, I know that's kind of laughable. But if you're living in Main Street instead of Wall Street, $500 a month is something that would be a reasonable amount. Now, figure that for a year. If you're paying $500 a month in 12 months, that's $3,000. That's basically a trading account. Now, not everybody is going to be able to put $500 a month in, but how about power and gas? You get your power and gas bills, what, $100 a month combined, depending on the size of your house, obviously. So over the course of a year, that's about $1,200. Imagine if you could put $1,200 back into your trading account whenever you want. It's going to kind of take that edge off in terms of trading. Car notes, groceries, basically just add trading in there. Figure, okay, put $50, $100, $200 a month aside, and maybe put in a savings account where it's gaining a little bit of interest. And so you always have that to fall back on. This is one way to fix the money fear, is to build your own discretionary income, not through brilliance in markets or picking the absolute right trade or anything of that nature, but simply saving. Something people don't really think about when they get into trading, but it's a good way to start. So when you're trading in the budget, now everyone is a little bit different in their financial position. Some of you, you don't need to worry about money, you got it all covered. Others, you want to get into trading because, well, quite frankly, you got to pay for the kids' education, things of that nature, and that's completely understandable. But, you know, just plan on putting a little aside each month. And here's the trick. Most months, you probably don't need to put that money aside, because if you're saving up the money in some sort of an interest-bearing account, it builds and it builds and it builds, and you can kind of skip a month and have that money that you were planning on putting into your trading account because you've had a successful couple of weeks or successful couple of months. You don't need it. So this is kind of changing the paradigm a little bit. We aren't afraid of losing money. We plan for it, and then when we don't, that's a great thing. And if you do lose, well, you already planned for it, so you're better off. You know, that's the real trick to becoming a successful trader, is to understand what our goals are. So when you don't need to put money back in your trading account, you already have it planned, or when you do need to put money, you've got it planned for, and when you don't, you get an extra couple of bucks, extra couple $100 in that month to go and spend on maybe going out to a date, going to the movies, taking your wife on vacation, whatever it is. So if we plan what we're going to do with the money, we end up being in a better position. This is kind of a psychological thing. It also allows you to trick yourself into getting into that viewpoint where we aren't afraid of losing money. We eliminate that fear by planning for it. Very simple concept. Now, the other fear, and this is the one that most traders, most professional traders suffer from, fear of losing. This is the actual thing that most traders are afraid of. For those of you who do this professionally, you understand that you're going to lose money. You're going to make money sometimes. You're going to lose money sometimes. There's drawdowns. There's build-ups. The market goes back and forth. But for most traders, it's an ego thing. It's not about the money. It's about being beat or beating the market. Think about trading the E-mini S&P futures, one of the most liquid markets in the world. When you step in and you decide you're going to trade in that market, you know you're trading against the best in the world. And so there's an ego thing involved here. And traders, well, we tend to be an egotistical lot. And you have to be. You have to have confidence to be able to make your decisions. Now, the catch is you got to be able to edge that a little bit. Most people who get into trading, most traders have been successful in something other than trading. So you have this view of your successful professional career, and what most traders tend to forget is what it took to get to the point where you had the successful career. The idea is if you had success in accounting, that you don't need to take the time to learn about a market because you already know how to be successful. Well, the reason you know how to be successful is because you took the time to learn about your profession. And if you're going to approach trading, you need to approach it the same way. Not from that end point, but from the beginning point. New traders aren't comfortable with the idea of losing because, quite frankly, most professions that you get into, losing is not acceptable. In trading, it is. You might have 4 winning days in the week, but you're probably going to have one losing day. Now, the idea is manage that risk. Manage the losses. And if you manage your trading properly, then at the end of the week, even though you've had some losses, you should come up ahead. And we have to build in our own mind the concept of getting there. So fixing the fear of losing, or fixing the losing fear. Number 1, accept it. That's the biggest thing. Most traders can't accept it. You know, I mentioned traders are kind of an arrogant lot, where it's slightly egotistical. I'm throwing myself under the bus here, so if anybody else is feeling inclined, feel free to jump in. But as big as our ego might be, the market's ego is a little bit bigger. So you kind of have to check it a little bit. We accept that you will lose occasionally. This is trading after all. If you want to win, if you want to be a successful trader, number 1, control the losing. Number 2, change the paradigm. Elite traders practice risk management. And you've heard a few things about risk management, the percentage levels, things of that nature. Never risk more than 10% of your account. Your maximum drawdown, 20%. You know, things of that nature. And I always love when I hear professional traders talking to new traders, people who are just starting out, about percentages. And, well, if you're just starting out, you're not one of these elite traders. And we've heard a couple of them talk in the room today. But if you're just starting out, you want to do something that I prefer to think of as survival management instead of risk management. And the differences between survival management and risk management. Number 1, risk management assumes you're going to win. Well, if you're assuming you're going to win, Well, number one, you don't realize what you're getting into. Um, Either that or you've done this long enough where you've got the confidence in your system, but people starting out probably don't have that confidence yet. So survival management is about an assumption of loss. And this builds up two different goals. The goal in risk management is keep your assets intact. And it's a good goal. And it's one that we all want to get to at some point. But you got to learn the basics. You got to put in the time. So the goal of survival management is about buying time. We want to buy time to understand a market. So let's show you a few things here. First of all, I'm going to ask you a few questions. Can you trade like a professional trader? Can you trade like a pro? I'm guessing the answer to most of these questions would probably be no. Most people probably aren't on the level of a Goldman Sachs or Tom Busby, who is our pro over at DTI. You guys probably aren't there. You want to get there. You will eventually, but just starting out, maybe not. And here's a big question. Are you committing the same size of account as the professional trader? When Goldman Sachs sweeps in with their multi-million-dollar accounts and you're sitting there with your $10,000 account, the playing field is not equal. And when professional traders talk about risking 10% of their account, well, 10% of a $100,000 account and 10% of a $10,000 account are not the same thing. 10% of your account, is 10% of your account the same as 10% of a Goldman Sachs corporate account? No, it's not. So if you're working a trade and you and the professional trader are each risking 10%, that means he's risking a lot more than you are. So at the point where you're getting stopped out, that professional trader is probably still in because the 10% level is not equal. And the big one, well, can you handle a big loss? The answer is obviously no on that one. Most people just starting out can't take a big loss, especially if you haven't planned for it. But the big thing here, do you understand the nuances of the market that you are trading? And the absolute answer on this is no. If you're just starting out, you have no idea what's going on in these markets. You might think you do, and you might have a little bit of a glimmer, but markets can be, they can be all over the place. I want to show you the money grid. This is a little thing that we developed for a survival management class, and what we want to do is we want to look at how much risk you would be taking. Your risk over here on the side, 2,000, 1,000, 500, 250, 125, 6250, 31.25. Basically, I just started dividing by 2 to get down to these numbers. Just kind of give you an idea. It's basic dollar amount, how much risk you're looking at. And in futures trading, we have some contracts that are going to line up with this. But consider if you put down a $20,000 account, all right, you want to go and trade in bonds, and someone tells you never risk more than 2 points in a bond. Well, 2 points in a bond is $2,000. So if you're risking $2,000 on a $20,000 account, and your first 10 trades are negative, you aren't going to last that long. Now, I would say that you start out thinking about doing maybe 1 trade a day. But even then, $20,000 account, you're gone in 10 days. Now, the CME has done a little research thing where they figured out that approximately, well, more than 90% of people who open a trading account are done within 3 months. Which means if you want to get to the status of being a trader, first goal, get past that 3-month deadline, because I guess they figured out that it takes about 3 months to begin to understand what's occurring in the market of your choice. to begin to understand those nuances and the way that the markets tend to move. So 3 months, 3 trading months, is going to be about 60 days. So what we want to do is go through here and find out where your 60-day mark is. If you've got a $20,000 account, you could risk up to $250 per trade, doing 1 trade a day, and if you lose every single time, you've got 80 days of trading. Now here's the neat thing about this. Your odds of losing every single time, even if you try, you aren't going to get 100% accurate. It's just not going to happen. You're going to accidentally fall into a winner occasionally. But if you go in with the idea of thinking about the market and just trying to put on trades and learn what's happening, and you've got planned out, the ability to put money back into the account if you need to, then you're essentially just buying time. And the more time you buy, the more opportunity you have to learn. Now, I'd love to be able to tell you that the more you learn, the more chance you will have at being successful, which I guess the probabilities would increase a little bit that way, but there's no guarantee that you're going to sit through an educational class on markets and come out being a better trader the next day. I mean, how many of you sat through a class in college and ended up a month after the class having no idea what the teacher was talking about? There is a big part of this that comes down to you and how much time you're willing to put in and what you're willing to learn. But that's the money grid. Kind of gives you an idea. If you're starting out with a $2,000 account, you probably don't want to be in the bond market. Let's see, $500 level, that'd be about half a point in the bonds. That'd be about 10 points in the S&P. And with a $2,000 account, you'd have basically 4 chances to get it right. Odds are you can't figure out what you're trying to do in 4 chances. Now come down here to the bottom of this list, 62.5 and 31.25. These, if you can find markets where you only have to risk this much, you've got a lot of time to figure out how to trade. $2,000 account, by the way, probably not enough to get started as a futures trader, but yeah, you could do some options, play around with some, maybe on a Nadex platform. There's a few things you could do. But let's go over and look at the market grid. Let me show you 6 equity futures markets. And typically what we're going to look at is each of these markets have movement rates, and then those movement rates define an amount of risk that would be minimal. So when I'm looking at an E-mini S&P, a minimal amount of risk on any trade would be about $125. Now, back on that money grid, the 125 line, let's see, where is that? 125? That would be 16 days with a $2,000 account, 40 days with a $5,000 account, 80 with a $10,000 account. That gets you into that realm of surviving past that 3-month threshold. The DAX, which is the Deutsche Aktien Index, the German stock index, roughly, or 300 euros per point, or 300 euros per trade is what you're looking at risking. It's actually, let's see, what is that? It's 25 euros per point, and generally with that particular market, the way it moves, you're going to have to risk at least, again, minimal 12 points. So that roughly translates out to a little bit over $400. The Euro stock's down here, 120 euros. It's 10 euros per point, basically $160. But you might notice that there's a market in here that really you could get into trading, and it's not going to cost that much. And that would probably be the Dow futures, where if you're risking about 12 points or so on a trade, and there are certain number levels where you can take advantage of that and use something like that. Take a number like 75, for instance. The Dow tends to move in little 5-point increments, so if you're pivoting around 75, if you break up to 81, go long at an 81 level, you put a stop back down at 69, the other end of that move from 75, and see if the market will run on that. And of course, then you get into managing the trade afterwards, but your initial exposure there is going to be $60. If you're wrong, you're out 60, and back on that money grid, goes into that 62.50 realm. You get started with that with as little as a $5,000 account and start to learn the way that that market moves and how you can adjust stops. So survival management here is about managing your ability to learn about the markets. It's about buying time. And it flips the paradigm. We're going to get to the next slide in just a second, but it flips the paradigm. Instead of a fear of losing, you almost embrace it. You understand that that's going to happen. You get that out of the way. And now your main goal is learn more so that you can become a more successful trader. I mean, after all, isn't that the name of the game? Didn't you get into trading because you wanted to have some sort of measure of control over your financial destiny? You wanted to be able to control your own money. Well, you got to learn about it. So another fear, a lack of confidence. It's a must for all traders. As I mentioned, we tend to be an egotistical lot. Losing has a way of breaking confidence. You can only beat your head into a wall so many times before that confidence just starts to melt away. So you've got to learn to trust your method or your system. Now, whatever it is you're using to trade, you've got to trust it. You've got to trust the people you're listening to or are telling you that this is what you want to do in the market. Now, virtual trading will help out with this a little bit, but here's the catch with virtual trading. It won't help if you use it wrong. It's hard enough to trade, but if you're sitting there on a virtual platform doubling down every time the market goes up a point or down a point, depending on the direction of your trade, you're learning absolutely nothing. So if you're going to use a virtual platform, use it for what it's intended, not as a video game. Because if used as intended, virtual trading will allow you to trust the method that you're trying to use. Because when you put real money on the line, you've got to be able to trust something. Because if you don't, that panic, which we all have, I don't care how long you've been in the business, everybody gets that little panic spike. And it's minimalized for those of us who've been in the market for a long time, have been in the business for a long time, but it's still there. And effectively what goes on, you get a little adrenaline rush going on. And the neat thing about this, physiologically, you become dumber when you're in a trade. So you've got to be able to trust in your method. You've got to be able to have a backbone there that you can sort of sit back on and lean on. All right, let me keep going here because I know that we're already over time. But let's talk about greed. Have you ever had a winning trade that became a loser because you wanted just that little bit more? I'm sure most of you would probably say, yeah, you've had that trade before. You get in there and trade's going great, and you're thinking, man, I could take my profits out here, but if it just goes another point, I can get that nice round number. And then, of course, it doesn't. And that's happened to everybody. And will continue to happen to you, by the way, no matter how long you've been in this business. That's just part of the way things go. And the other part of greed, which is the exact opposite here, have you taken profits out too early just to see the market run in the direction you thought it was going? This is actually, for me personally, this is my biggest struggle, is locking in profits and walking away with that win and then leaving money on the table. And I'm sure many of you listening today have been through the exact same thing. By the way, we're getting no questions from the room. I'm starting to wonder, James, if everything's working. We are still working, right? I mean, things are good here. I assume you're going to tell me if they're not. Okay, I'm going to keep going. So, ways to overcome greed. First of all, plan your trade before your entry, not afterwards, because it doesn't work that way. I mean, if anybody out there has ever parachuted, if you've ever parachuted before, the idea of trading without a plan or getting into a trade and then trying to decide what you're going to do about it is sort of like jumping out of a plane and saying, did I remember to bring my parachute? That's not a good idea. It just doesn't make any sense. But you'd be surprised how many people do that. And I'm sure you'd be surprised to find out that, like myself, you may have done that on occasion. So we need to stop that. We need to be somewhat disciplined in the approach markets. And you've got to plan your trade before entry, keyword there being before. Trade your plan. When you start to change the plan in the middle of the trade, it generally doesn't work out well. Now, occasionally it will. Occasionally you're going to make a great trade and things are going to be incredible and you were brilliant and pat yourself on the back, but most of the time, when you start improvising, there's a reason improvising and impoverishing kind of go right along the same line. So improvising, especially when you're very new to the market, not the best idea. Manage your risk, but don't micromanage it. I mean, the idea of writing a trade down, I'm not a big fan of it. If your trade's going against you, cut it. Move on. The great thing about the market, it's gonna open up. Futures markets open up Sunday night. Equity markets open up Monday morning. And there will always be another day. There will always be another trade. And here's the catch. If there's ever not another day or ever not another trade, then it doesn't matter because money wouldn't mean that much anyway. If the markets just fell completely apart, you know, a lot of people are saying, well, you got to be able to sell when the markets fall apart. Well, hang on. I certainly agree with the idea of trading, but if a catastrophic event occurs, then what use is having paper money at that point? We're on a fiat-backed currency. You need the markets working to have that money mean anything. So manage your risk. And don't micromanage it. The biggest problem that most people have is they micromanage their trades a little bit. They get to the point where you got that 2-tick profit and you move your stop up to 1 tick. And that's all fine and good right at the beginning of a trade. But if you're an hour into the trade and you keep bringing that stop up, then basically what you're saying is just take me out, take me out, take me out, take me out. Well, eventually the market's going to listen to you and do that, and then might continue on with the move. So best way to avoid micromanaging the trade but also manage the risk is to work up through time. So for instance, with an intraday trade, after entry, maybe focus on a 5-minute chart and look for the ability to lock in profits. Now, once your profits are locked in, go up in time. Go from a 5-minute chart up to maybe a 30-minute chart or a 15-minute chart, but always go up in time. Now, I prefer to stick with about a 30-minute chart, but after going up in time on those charts, after locking your profits in and then going up in time, let the chart show you the trend and move your stop accordingly. And I can get done quicker than that, James. I can be real quick on this, but okay, no more than 15 minutes. All right, so these are the trending patterns. Uptrend. The market is showing a higher high and a higher low. In a downtrend, it's showing a lower high and a lower low, and inside and outside bars. But here's the catch, and this is very simple. if I'm looking at this bar pattern and then I start forming another bar, if this bar pattern is going to continue, then the market is not going to go below the low of that second bar, which means I can raise my stop and let the trend decide how long I stay in the trade. So when we get to that larger time frame, we can be a lot more relaxed about the market, and we don't have to try and second guess everything. If you're trading along with the trend, it'll tell you when it's time to not be in that position anymore. It'll tell you when that trend is over. And those, just charts, bars on charts, that's all you really need in terms of managing the risk once you're in that trade. So a couple tools that you can use. We've got a software program over here at DTI, Roadmap Software. Based around the DTI method, tracks the market 24 hours a day, tracks futures, options, stocks, all that, anything you want to look at. And I want to show you a couple features here. First of all, custom page or a quote page. Now most of you probably have a trading platform or an analytic platform, charting platform that has a quotes page. I'd love to tell you how great ours is in comparison, but come on, it's a quotes page. It tells you where the market's trading. You can get the open, you can get the high, you can get the low, but this is basic information. Now what shocked me is I find traders who don't pay attention to this. Well, if we're trading up near the high of the day and you're all of a sudden deciding, well, I want to go long the S&P, using this example, this was Friday's market, I want to go long the S&P at 1873. I'm going to tell you, hey, something you might want to consider. The market has already shown resistance at 73, 75. Maybe either let the market pull back so you have some room to climb up to that number or wait for it to break through. So we want to pay attention to these basic things. And most of us, when we're presenting, we assume that people know the basic stuff. And one of the things I've found out is that, no, not everybody does. You should, and once you think about it, you go, oh yeah, of course I knew that. But you'd be surprised how many people don't think about it when it comes to a trade. So be aware of the open, high, low, what's going on in the market. And any quote page will do this, roadmap custom page or your quote page in any other market. Now, we do have one thing that's kind of unique. It's the ETR page, which is electronic tape reader, tracks the market 24 hours a day around the globe. And what we're looking for here gives you market direction. What we're looking for, this is on a 30-minute time frame basis, and I'm looking at, is the market moving up or down? And I've got several indicators all lining up, so when I get a nice little green area, that's telling me that the market during that time frame should be bumping up a little bit. But pay attention to a few things like, for instance, bond markets closing, European market coming to a close. These kind of things will have an effect on the market, so you need to pay attention to time. But being able to put several different indicators in this one page and just see that color coding come in really makes things a little bit easier. And then the roadmap compass, which is basically your chart. This is on a 30-minute setting. I used Apple as the example here. The compass is a tool used literally to tell you where to enter the market. On the left side, it gives you vital signs of the market you're looking to trade. And what we're looking at with Apple, we have a 520 opening price there, and this was obviously from before the earnings report. The buy zone area where you look to start to consider a long position, 522.78. The target number on this particular move was 528, and obviously we've gone way past that target. And then you have a sell zone area because you don't want to get tunnel vision. You have to be aware of both sides of the market, and people don't like to do that. And I've always been amazed at that. If you're putting a stop in, if you're trying to manage risk, the stop, if you're long in the market, the sell stop is where you don't want to be long anymore, the best place to do that is probably the place where you would want to be short. So if you look at the market, both sides, this is where I want to be long, this is where I want to be short, let the market show me what I should be doing, well, then you've already got the risk management kind of taken care of, at least initially. If you want to be short, then you don't want to be long, and if you want to be long, then you don't want to be short. It makes too much sense, which is probably why people don't think about it that much. So lessons learned here, you've got to be persistent in your approach to the market. You have to have some sort of a careful plan, and you have to study the game. You've got to really break down and see what these markets are all about. Casual traders don't really exist. If you want to throw money away, I can give you my home address and accept checks. I mean, if that's the way you want to do things. But if you really want to get involved in trading and learn how to be successful about it, study the market. Learn what you're doing. Don't worry about yesterday, focus on today. This business of trading is the ultimate what have you done for me lately business. You can be the most successful trader in the world. And tomorrow, everything changes. So you've got to stay on top of it. It's continuing education. You've got to continue to learn. Educate yourself. This one's simple, but you got to keep stating it. Do not risk money you cannot afford to lose. If your trading account is funded by your kids' college tuition, you will lose that college tuition because that's going to be on your mind. It's going to impact the way you make decisions. It's going to impact the way you trade. So, earlier, put in your budget. Put a little bit of money in your monthly budget, set it aside, and then you're not worrying about that because you're trading money that you can afford to lose because you've planned for it. Learn from every trade you do, the good ones and the bad ones. Analyze and critique yourself continuously, but always trade in the present. Now, I do have a little bit of a link here. Let's see, lessons and insights about futures, options, and stocks, plus Tom Busby's 7-11 rule. And if you fill out this simple survey, you receive a copy of this information. Survey link, and James, do you need me to send that to you?
No, I don't. What I'll do is I'll copy it.
DTItrader.com/survey.
Exactly. That's exactly what I'm going to do. I'm going to type it right now.
Okay, thank you. So if you want to click on that link, find out a little bit of information about us, and you can go to DTItrader.com to find out more. If you have questions, I think we're already a little bit over time, so you can email questions to me, crow@dtitrader.com. That's CROW@dtitrader.com. You can visit our website. You can give us a call on Monday morning. We'll look forward to hearing from you. I want to thank everybody for your time. And James, I'm going to go ahead and turn everything back over to you and let you guys get on with everything. I got to go to, we have the mullet toss down here in Mobile, so I got to go throw some fish.